Well, good morning, everyone, and welcome to Bloomberg UK. I'm Francine Lacqua here in London. The Bank of England Governor Andrew Bailey has raised the prospect of rate cuts for Britain before the Federal Reserve moves. While speaking in Washington, Bailey said the UK and the rest of Europe are facing less of an inflation threat than the US.
We're in the position where we're seeing this process of disinflation. I expect that next month's number will show quite a strong drop because we have a particularly unique household energy pricing system in the UK.
Well, the UK Chancellor Jeremy Hunt says that this week the prospect of rate cuts later this year would lift the mood of voters. Now, he's hinted that the Prime Minister will not call a general election until the autumn. Well, Hunt made the comments before the latest inflation data, CPI, slowed to 3.2% in the year to March. And that's, of course, the lowest in more than 2 years, but a touch higher than expectations.
It's certainly the case that, the feel-good factor as interest rates start to come down, as people start to feel higher real disposable incomes, will be stronger in people's minds come the early autumn than it is now. People have been through a very bruising period. Obviously, decisions about election timing are for the Prime Minister, and were we to have an October election, as I've said before, it would be possible to have a fiscal event in September. But we would decide much nearer the time whether that was the right thing to do.
Well, of course, you've already delivered a lot fiscally in terms of tax cuts, including personal tax cuts. And yet, when you look at polls, obviously the Conservative Party is still running significantly behind Labour, I believe by roughly 20 points. What else may need to be done on that front to convince UK voters to keep the Conservatives in power? What would you consider doing?
Well, I'd be very cautious about looking at those polls because, first of all, as we can see from the challenges facing incumbent governments, not just in the UK, but in the US and Germany, France, the electorate have been through a really difficult period with an energy shock, with high inflation, with a pandemic. But when it comes to a general election, it's a choice about the future. It's not a referendum on how you feel right now. And that becomes a very different decision in people's minds.
Well, that was the UK Chancellor Jeremy Hunt there speaking to Kayleigh Lyons earlier this week. Now, from the current Chancellor to a former one, Philip Hammond has told me he's positive about the country's economic outlook. Now, he also warned that the UK should only cut taxes once public spending is under control.
I agree with the Chancellor. I think the UK growth prospects are significant. We've got a very good track record of technology adoption. British people are very open to using technological innovations in their everyday lives, more so than in many other countries. So the raw material is there, but we've got to make sure we seize the opportunity. And one of the challenges of democracy, of course, is that we have to persuade people that they want things to change. And people are very conservative, with a small c, often don't like change. And it's about selling change to people, working out how, in a democracy, we have those big debates and we reach the right long-term decisions around these big, difficult issues. Because many of our adversaries and even many of our friends around the world who are competitors with us don't operate the same kind of democratic system, don't have to build the same kind of consensus that we do in the liberal democracies of Europe.
But one of the more immediate, and these are longer-term, extremely difficult subjects, very important. On the short term, I mean, does it make more sense to increase defence spending or cut taxes? And that could also lay the foundation, actually, for future growth either way.
Well, look, I'm strongly in favour of an agenda to cut taxes over time as we can afford to do so. But we can only cut taxes if our public spending is less than our tax receipts. Driving economic growth, achieving higher levels of economic growth should increase tax receipts and should ultimately enable us to have both lower taxes and higher spending on public services, including things like defence. But we've got to do things in the right order. First, you grow your economy, and that requires investment, maybe at the expense of consumption. But the consistent theme, if you look across countries around the world that have achieved decent levels of economic growth over long periods of time, the consistent theme is high levels of saving and high levels of investment. And we've got to do better in that area. Once we've done that, and we're running surpluses in our public finances, then we can start looking at cutting taxes. I'm afraid, as Liz Truss and Kwasi Kwarteng demonstrated a couple of years ago, trying to do it the other way around, cutting taxes first, funding it by borrowing, simply doesn't work.
Well, that was the former UK Chancellor Philip Hammond. Now, coming up, a stronger than expected UK inflation tempers rate cut bets. We look at whether central banks should ditch their inflation targets for something more flexible. That discussion is up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg UK. I'm Francine Lacqua here in London. Now, yesterday, the BOE Governor Andrew Bailey shrugged off a smaller than expected drop in UK inflation. That prompted traders to unwind bets on how many interest rate cuts the bank will deliver this year. But should the BOE drop its rigid 2% target altogether for something more flexible? Let's bring in our panel, Bloomberg's John Stepek and Marcus Ashworth from Bloomberg Opinion. Marcus, I love your piece. So basically, you basically argue in your opinion piece just yesterday that it's time to retire the 2% inflation target. I think it's easier, isn't it, to do it in the UK than, for example, for the Fed or the ECB to do it?
Oh, I don't think it's a question of timing. I think they can all and should drop it. Perhaps it will be easier if the Fed does it first, but it might be easier for the world if the Fed cut first, but we may not get what we want. So I just think if we've had this huge Bernanke review, which, one wasn't needed because most of it was absolutely patently obvious. But if the Bank of England does get in reform mode, let's pray they do, why don't they go at it properly and reform the whole regime to create something which makes sense? Because you can't and you shouldn't steer an economy on one constant, literally just trying to aim at 2% the whole time, come what may, because I don't think the economies are quite so biddable. I don't think the inflation data is good enough. It's lagging. They can't calculate it properly. And everything else is beholden to this sort of one rule to rule them all. And I don't think it works. It never worked, in my humble opinion, but it's certainly the benefits it once had are embedded, and I think that they can improve it by having a little bit more flexibility. And let's move away from, oh my lord, it went 3.2, not 3.1. How stupid is that?
Yeah. So, John, Marcus and I usually see eye to eye. On this one, we probably don't, just because they've missed the target for so long. Then if they just get rid of it because it's a little bit high, it just seems like it's gaming the system.
I mean, yeah, I agree with you. I do think the problem is that if you get rid of the target, and you say, well, let's be more flexible about it at this point, then as you say, it does look as if they're kind of giving up a bit. Yeah. And also, with that problem is, so what do you replace it with? Because the one benefit of an inflation target is that it's a specific number. Yeah. It's very obvious, it's easy to communicate, and central bank policy is hard to communicate in the first place. So saying, well, what do you make it instead? And I do think that's kind of the big issue. And also, I would say that I'd be concerned if the Bank of England went first. Right. Because if we look like we're the ones who are slacking off and controlling inflation, then, I mean, my first expectation would be that the pound would fall quite significantly. Now, OK, probably doesn't matter in the long term, but in the short term, I mean, this is something that I feel probably the Fed has to take the lead on if it's going to change at all. Yeah. And in the meantime, I mean, my own view is that central banks probably we should reconsider the whole role of central banks anyway. Yeah. So I'm probably not the best person to ask about this in lots of ways. But anyway, yeah, so I think there's a danger there. OK, but you're not quite like the Argentinian president, right, who just wants to get rid of central banks. Are you, John? Let's talk about that another time.
OK, well, we can talk about it now. But, Marcus, so I guess, and actually in your article, again, you put it, does not mean that inflation should be allowed to rip. I guess one of the concerns that people say is then politically, if you don't have a specific target that you can justify, then politically you could get a lot more heat from the people in charge. And I guess a central bank still needs to be independent.
Well, it's worked, we say, sometimes not quite as independently as you would think it would be, particularly through QE and matching government issuance. But look, my point here is not to do it at 3.2. My point is to do it at 2% and or below, which is going to happen next month and possibly go down to below 1%. At that point, then is the time to change your inflation target. We didn't want to do it, right in the start of or during an inflation surge, obviously. That goes without saying. And John's point about the pound is correct. You've got to do this in a way which is carefully, clearly telegraphed what's happening and better in conjunction with everyone else. That doesn't mean you all go to the same range or you change it in the same ways. It's just there needs to be a little bit more flexibility for each economy and changing that range. Just de-emphasizing the inflation target as being something which is the only thing which we can look at as far as monetary policy. And how monetary policy works with fiscal policy, because that's what's gone completely haywire. And look what's happening in the States with massive stimulus, which is throwing literally the whole world economy off track.
Yeah, and this, John, I guess, points to the fact that in the last week, we've had incredible movement on the markets, right? Global interest rate markets are basically in a flat spin, bleeding into equity markets. There's been a huge repricing of treasuries.
Yep.
Is it actually justified?
I think it is justified to an extent because, we're waking up to the fact that interest rates in the US are going to be higher for longer. And, when you think about it, in December, markets were pricing in 7 quarter-point rate cuts from the Fed, and they're now down to, 1 or 2. And some people are even, Larry Summers has said that, there's a 20% chance that rates will go up this year.
Do you agree?
I think that's probably punchy. I'd be surprised if US rates go up, simply because, the other thing is you've got to take into account the fact that this is an election year on both sides of the Atlantic. Central banks are probably now within the zone of whatever they do is going to be seen as political interference, particularly in the US. And so I think that that's kind of politically difficult, despite the fact that they're ostensibly independent. Yeah. But having said that, I think that, markets have probably been a little bit too comfortable with the idea that rates were going to cut this year. And now that they're waking up to the fact that they're not, then I think the repricing probably is justified. And also there's going to be an element of turmoil arising from that.
Marcus, how problematic actually is the dollar strength? So we saw Janet Yellen flanked by the Korean finance minister and the Japanese finance minister saying, look, she wasn't going to push back against intervention. But how problematic is it for the UK?
Well, the UK, we don't tend to talk about currencies because we don't care about the pound. The Bank of England has consciously, deliberately ignored it for many years, and no doubt will. But it's interesting the ECB president, Madame Lagarde, did mention the value of the euro. So this is not just an Asian problem, though it's worse in Asia. And clearly the fact that Yellen has had to step in and show that the dollar strength is a problem, I think is the first and about time recognition of this. I think the dollar strength has gone too far. I think Yellen's admitting that. And the fact that both the Bank of Japan and probably Korea will at some point intervene. If the Fed comes along and does it with them, which is a possibility now that Yellen has mentioned that she thinks there is, some issues here, then maybe we will see, what at the moment is a bit of an overrun. It's not a crisis. We're just getting, it's a little bit painful, too painful perhaps, particularly in Asia. And, the ECB wants to cut interest rates. What's possibly holding them back, or the amount they do cut, would be if the euro dropped to parity with the dollar. So it's not helping anyone, including the US, that the dollar is this strong.
To both of you, but maybe, John, you can kick us off. Is it really... I know this is where we are, and actually the inflation picture is so different in the UK and Europe than the Fed, but there's still the gravitational pull of the Fed. So I don't know how easy it's going to be to pull off to have an ECB go first in terms of cutting and then a BOE second. Yeah,
definitely. And I also think the dollar that's the main part of this, because, the Bank of England and the ECB will be worried that obviously they'll stoke inflation because strong dollar drives up kind of import prices. And the UK in particular, we're very dependent on energy imports, and the last thing you want to see is the petrol price going up, because that feeds through practically immediately into the inflation figures. So if nothing else, it looks bad. I think the fact that Yellen obviously has recognised that this is a problem and is basically given the green light to a weaker dollar policy. And she's going to be aware, this is really important for the US election. A stronger dollar means weaker asset markets, which means everyone feels poorer. Yeah. They don't want that going into the US election, so I would think they'll find a solution somehow.
So interesting. Thank you so much, both of you, for joining us, John Stepek and Marcus Ashworth. Now, be sure to subscribe to Bloomberg's In the City podcast that I host with David Merritt and Allegra Stratton on Apple Podcasts, Spotify, or wherever you get your podcast. New episodes drop every Thursday. Now, coming up, as luxury faces a slowdown globally, we'll discuss the outlook for Britain's luxury sector. That's next, and this is Bloomberg. It's shaping up to be a year of changing fortunes for luxury. The European luxury industry faces a significant first quarter slowdown. Here in the UK, a difficult economic outlook, Brexit, as well as a loss of tax-free shopping for visitors to Britain add to the challenges. Now, a new study has shown the UK luxury sector actually contributes £81 billion a year to the UK economy, supporting almost 500,000 jobs. Now, the research has also found that the luxury sector's economic contribution to Britain has grown 69% over 5 years. The study was carried out by Walpole, the official industry body for UK luxury. Well, joining us now is Helen Brocklebank, the chief executive of Walpole. Helen, thank you so much for joining us. I mean, this is a widely exciting industry because it has grown so much, and I wonder whether you feel it's gotten the proper support from government.
I personally don't think it has, because if we were in France or in Italy, we would be garlanding this sector with laurel wreaths galore. I mean, we think about LVMH was last year the first $500 billion business this continent has ever had. So I think that £81 billion and nearly 500,000 jobs says that this is the great economic powerhouse the government doesn't realise it has, and we've got to change that.
So what would you do what do you need from government that would actually help you? I know there's been a lot, and we saw the Burberry chairman just last year also stand up in a room full of, 600 people saying, we need those VAT refunds, otherwise you miss out people coming here and spending and shopping.
Well, 4.5 years on tax-free, the lack of tax-free shopping continues to be a thorn in the side of every business that's connected, not just retail, but the whole ecosystem, because it means that we are reducing our competitiveness with our nearest neighbour. So we're very close to Paris and Milan, and it's an international audience. Why are we not fighting on a level playing field and just offering the same things? It also affects foreign direct investment, which is very, very dependent on the allure of British luxury. So let's change that. The other big ask from us is about geographical indication status. So this suit is made with Savile Row bespoke tailoring skills. This is from our textile industry in Scotland. We have incredible regional clusters of employment. If we had geographical indication status over and above, agri-foods, whiskies, etc., we could really protect those skills and protect those 500,000 British jobs.
And we have seen, Helen, a couple of brands actually go in there and trying to take care of the savoir-faire, the manufacturing that the UK has been so good at. What else do you need? Is it, investment money coming in at a certain stage when a luxury company starts out, or is it support at a later stage when they're bigger?
I think it's a bit of both. I think first of all you need the recognition that we've been asking for, and that really that does start a lot with protecting the skills that really make sure that we've got that savoir-faire here in the UK, and as far up to the Highlands and Islands of Scotland and down to Cornwall, we're really delivering that beautiful made in Britain thing. I think from an investment point of view, these businesses are, like Church's Shoes in Northampton is owned by Prada, Belmond, an incredible British hotel group owned by LVMH, so they're very good at direct investment. But I think recognising that these businesses grow slowly but are super resilient, deliver value over time, is our message to investors.
Is it more difficult now with supply chains? Again, luxury has had a little bit of a boom. I don't know whether it's post-COVID, but people are treating themselves. People wanted to buy luxurious things. We could see now a bit of a downturn, also at a moment where there's less multilateralism. So how is it tough out there at the moment for the luxury sector?
We're seeing very much a normalisation, and I think those LVMH figures of looking at 2% growth is an interesting sign. So, but off the back of an enormous post-COVID boom. But in the UK, our sector is really, really broad. So it's a very resilient sector. The great unsung hero of British luxury is the automotive. So Rolls-Royce, Aston Martin, Bentley, iconic things. And actually, that's a sector that's doing incredibly well, as is whiskies, huge export. So our risk is spread very, very wide here in the UK, a unique factor of this economy.
What do you think will make the difference compared to other luxury markets in 2 to 3 years? I mean, also the, as you say, whiskies, but also a lot of the apparel that men have are maybe other, things that other countries are less focused on.
We have an incredible strength in menswear. You think about brands like Dunhill, and also I've mentioned Savile Row Tailoring and the Northamptonshire shoe hub. So I think it's really about protection and recognition, and making sure that we've got access to international markets. Yeah. The sectors deliver. In the UK, we have £56 billion worth of exports, and that's important because every time you're buying a Burberry trench coat or a Church's shoes in the Middle East or in America, you're really supporting British jobs, but you're taking a bit of British quality out to the rest of the world. I mean, we also are in an election year where Labour is very much ahead in the polls. Have you had any reassurances from them that actually they will support your industry? I think there is a recognition there that the export is such a strength of the sector, and to recognise that 56 billion, but the fact that it also supports those jobs. But it's a crucial time for us to do this research, just putting that nearly 500,000 jobs on show, so that we really see why luxury really matters.
Helen, thank you so much for joining us.
Thank you so much.
Helen Brocklebank, the Chief Executive of Walpole. Now, another reminder to subscribe also to our podcast, In the City. There's another episode out today. We'll have plenty more on markets. We'll have plenty more on the UK and what we heard from Andrew Bailey, the Governor of the Bank of England. This is Bloomberg.